Looking back over the past week, New Zealand dollar had a mixed experience. The New Zealand dollar initially depreciated over the first half of the week, but then recovered ground over the second part, with momentum continuing through the weekend. The New Zealand dollar initially declined at the start of last week on the back of the weak Q4 retail trade report and poor global confidence. However, by midweek, the New Zealand dollar had recovered on the back of strong global commodity prices and strong demand for commodity currencies, including the New Zealand dollar and the Australian dollar. In addition, investors pulled back on the US dollar on speculation of a later start to interest rate increases in the US. In particular, the release of the Federal Reserve minutes showed that Fed members were still very concerned about the sluggish pace of recovery in the labour market in the US. The New Zealand dollar gained momentum over the second half of the week, which then continued through the weekend, with the New Zealand dollar now trading above 76 cents this morning. It was also a strong week for commodities, with dairy prices increasing again in Fonterra's global dairy trade auction. In addition, wheat prices continue to surge higher. There are concerns for severe shortages in wheat product following Russia's crop being affected by drought and fire and a ban on Russian wheat exports, in addition with growing drought concerns in China. As a result, wheat prices are continuing to surge higher, and this will drag up grain prices more generally and help underpin support for dairy prices over the next year. One of the key developments for last week was China's January CPI result. Inflation lifted to 4.9% in January, although this was weaker than expected. Stripping out food prices, core inflation is running at a much more subdued 2.6%. While that we're seeing core inflation running below headline in China, it is nonetheless accelerating. Reflecting this, the Chinese authorities moved to tighten monetary policy measures yet again by increasing the reserve requirement ratio over the weekend. This effectively slows the amount that banks can lend, but without increasing interest rates in China. The Chinese authorities are focused on slowing growth to a more sustainable pace to prevent inflation pressures from building and to prevent asset price bubbles forming in the property market. Our Asia-based FX strategist believes that the Chinese authorities are going to be very successful by using a wide variety of measures, including increasing the reserve requirement ratio. Seeing Chinese growth continue at a steady but sustainable pace is key for supporting New Zealand's dairy and meat prices over the medium term.